Welcome to season 2, episode 3 of our podcast. We're experimenting today, doing something a little different.
Probably noticed we're in a different area. There's a big W behind us.
If you're watching on the video,
kind of it.
We're also experimenting in that we thought about what this episode should be about. And so we're going to both try to get what we wanted to out of this episode. So join us for the roller coaster and we'll have some fun. And if you're not watching on YouTube, you might want to. We might get in a fist fight or something. You never know.
Probably not. Welcome to Wealth Wisdom Financial Podcast. We believe when conventional financial thinking doesn't get you where you want to go, you need wealth wisdom. So don't forget, hit that subscribe button. And if you're watching on YouTube, give us a like and comment below. And we are going to be bringing up some other comments, other YouTubers out there that, they get a lot of comments and they flat out lie.
Yeah. So part of what we thought about today is I wanted to go back to season 1, episode 2, back 5 years ago and talk about debt. And as we were preparing for the episode, a certain radio personality, it was a YouTube channel, who we will not mention, but his name rhymes with Shamsy, came up with a video that was pretty frustrating to us, to say the least, right? That we were not agreeing with anybody in the video, actually, and it was really hard to watch. And then at the same time, there's been lots of things happening with the economy, and I found this Federal Reserve report that came out that I'll read a little bit from later that was like trying to calm everybody down, but also like not drawing attention to what we should be thinking about. So I wanted to talk about that. Brandon wanted to talk about the lies. And I think we both agreed that at the end of the day, we want to be a channel that's bringing hope and encouragement and helping you believe a better future is possible. If you want to go back and look at season 2, episode 1, where we celebrated 5 years of the podcast, if you need some extra inspiration today, you might go back to that. We talk about the adjacent possible in there, and we've gotten a lot of good feedback about that episode. So today we want to bring you some hope, some positivity, help brighten your day, despite all the lies and just, you shouldn't worry, kind of, talking down out there.
Well, and I will call out the person that was saying that infinite banking and his thing against what we do, again, was Dave Ramsey. And he did a video, said all kinds of things and lied on there. And we can prove it just by looking on the internet for 2 seconds.
Well, and not just the internet, but like the FDIC's, government approved website and data about, like, for instance, do banks do life insurance? You betcha. We looked up one bank that had over $1.8 billion in assets at one bank. And you can easily go on the internet, go to that government website and look up banks and how much life insurance they own.
Yeah. So we're not going to say, what I learned is there's a lot of people who are just following the same advice, saying, you're just going to go into doing the Wall Street stuff and you're going to get 11% rate of return. It's going to be perfect. Don't do this because it's not a great investment, which, by the way, when we do talk about banking yourself, we do not say it's an investment. We never do, never have.
It isn't. We can get in trouble if we call it that.
And it is not an investment. But it is a good place to build a good foundation, emergency funds, those kind of things, to be able to overcome the storms that will happen, but are happening right now. So Amanda, share this article, quote from the Federal Reserve.
Federal Reserve of New York published a blog post in August with a snapshot of where household debt is currently. And they did a whole study, but then the blog post is kind of a summary of it. And I'm going to read the last paragraph of the blog post. You can check out the full post. I'll make sure we have the link in the show notes. But here's what it says. Despite the many headwinds American consumers have faced over the last year, high interest rates, post-pandemic inflationary pressures, and the recent banking failures, there is little evidence of widespread financial distress for consumers. Let me say those last words again. There is little evidence of widespread financial distress for consumers. You're a consumer, I'm a consumer. Any evidence in your life of widespread financial distress? Let me keep going. Continuing the quote here. American consumers have so far withstood the economic difficulties of the pandemic and post-pandemic periods with resilience. However, rising balances may present challenges for some borrowers, and the resumption of student loan payments this fall may add additional financial strain for many student loan borrowers. Even so, thus far, household credit shows some early signs of stabilizing at pre-pandemic health, albeit with higher nominal balances. End quote. Let me translate what they said. So household debt is higher than it was pre-pandemic, but we shouldn't be worried because there's not signs of widespread financial distress. We're buckling up. We're being American, resilient, awesome people. That's what the Federal Reserve's like. Everybody calm down.
Don't worry about it.
Yeah.
Don't worry. Just keep going along, and don't worry about the cost of eggs, the cost of anything. Well, it'll be fine.
So here's what I'm worried about. If I look into the future, which none of us have a crystal ball, none of us know what's going to happen. But if I use financial planning sense that I've studied and thought about a lot, if I have higher debt, if there's high inflation, I'm spending more at the grocery store, I might be able to stay resilient in the short term, but at the expense of what? Right? I might be able to restart my student loan payments this fall if I had them, but at the expense of what? And what I want to see is on the flip side, where we've seen the national savings rate, how much people are saving, dwindle. It went up a little bit during the pandemic, but we're back at pre-pandemic lows and even lower. Back, 90 years ago, Americans saved 30% of their income. Today we're saving less than 5%. And we pretend like that's not going to catch up to us at some point.
And I think that goes back to, for me, the Dave Ramsey thing where he's saying, oh yeah, well, just put it all into this thing. It's a great place to invest. I never said, again, we need to be savers, not just investors. And where do we put money to then leverage and use in the right way, if we can, and how should we, right? In an emergency or not. So
one thing we didn't have 5 years ago that we have now is a whiteboard. A vibe board actually is what it's called. And I'm going to do some drawing with my fun handwriting of what we believe is one of the most important things to be thinking about when it comes to debt and saving. And if you want to apply it to investing, maybe we'll talk about that.
Sometimes.
Okay?
Yeah.
So here I go. Here is just a blank screen. And what the Federal Reserve is talking about is, let's say this is zero. I'm actually going to draw this all the way across. That's $0. And then let's change this to red. What is happening when you go in debt is you go negative. And then you crawl your way back up, making your payments, being charged interest, and eventually you get back to zero. And then, so this could be a student loan that you finally repaid. Yay, I'm super excited.
You yell, I'm debt free, right, as somebody entertainer says.
Yeah. But then you need a car. And so you go into debt to get that car. You repeat, rinse and repeat, you're charged interest. You eventually pay it back. Yep. Maybe it takes less time because maybe the car is less expensive than the student loan, right? Yep. And you just keep this cycle going throughout life. This is what we call the debtor's staircase. So I'll write that down. Debtor's staircase. Okay. Now, what a good saver does, we'll do this one in green because it's the opposite. What a saver would do is maybe their parents really smart and they saved up for college little by little over time. And then when you turned 18, they started, it corrected me. It likes what I drew there. Let me go
It wants you to do a,
up and to the right.
yeah,
Okay,
there you
we
go. Oh, look at that staircase.
Yeah, there's a staircase. Maybe parents saved a little bit more sometimes, a little lower sometimes. But then you go to college, right? And it's gone within those 4 years. Maybe it comes down in four stages, or maybe it all comes out all at once. And then you need a car. You're the smart one that learned from your parents not to go into debt to buy that car. So you ride the bus, you use the junker you got for your 16th birthday, you know, whatever. And then you go buy the car, you're back down to zero.
But you've been investing, of course, right?
Let's not get into that. So this is just the savers staircase.
Yeah.
So we're not saying where this money is going. We're just saying that it's being saved. And we can debate where it should be saved, how it should be saved. That's maybe a different video. But at least saving, making some interest on it as you go. But you'll notice that these are very similar to each other. It's just a cycle that gets repeated throughout one's lifetime. It could start when you're a kid. It could start when you're 22. It could continue as you pay for your own kids' college or help them buy their first car when they're 16, or, you know, car after car, or down payment for a home, pay for a kid's wedding, you know, the sports, all the things of life.
Yep.
You either go into debt to pay for them or you save up for them and pay from your savings. This is what all of us do.
Yep.
I can't think of a different alternative unless you've created what we like to call and love the trademark of the bank on yourself type whole life policies. Now let's talk about how this is a little different.
Now, this is where Dave Ramsey will again go and attack and say, oh yes, but it's the investment. It's just not a good thing. You shouldn't do it, blah, blah, blah. And I will tell you, we've been able to use our policies, leverage the loan feature to be able to buy assets, to do things that have helped us grow our wealth. But it is in essence saving. So that way, if I don't know, eggs become $15, we can still have eggs if we need to. And, you know, not that that would be what we would do it for, but.
Right. What you're hyperbole. Okay. So let's go over here. You might have to move out of the way or something. We'll see how this works. So here's your whole life policy, potentially, where you're saving up in it. The cash value is increasing just like it normally would, right? And if it's designed properly, it continues growing, maybe slower than the mutual funds, maybe faster sometimes, right? One of the things that we have to talk about is that mutual funds go up and down and sideways. You never know what it's going to do. There's a lot of predictability with savings vehicles. That's why they're called savings vehicles, not investing vehicles. Investing is money you can afford to lose. Savings is money that you want safe and growing at a predictable rate. So here you are saving, and you still need the new car. Or the example in this gentleman's case is he started a policy on his son who's young, and he was going to maybe use it for college or, you know, something like that, we imagine. So what's interesting is, let's say you take the same amount. Actually, I should make that. Let me go back. Let me make it straight down, right? You take a max policy loan, and then you start repaying yourself like a good person, right?
Paying the insurance company, but
right. You're repaying the policy loan. Yeah. You get back to even here, right? But you're still getting this growth here. So you end up here rather than here. For those listening on the podcast, what I just did was I took a vertical line straight down, and then we repaid it till we got back to where we were, and that created a horizontal line. But instead of being where we were, because the cash value was still growing, actually end up at the policy ends up at a better place.
Yeah.
Because we're working with companies that give the same guaranteed growth, the same dividends as if you didn't take a policy loan. And that difference over and over and over again can make a really big difference long term. And sure, if you love mutual funds, we're not saying put all of your money here.
Yep.
We're saying do the mutual funds, do the stocks. Maybe this becomes the safe side of your portfolio, maybe a bond replacement, or maybe just what you would have kept in your savings and been responsible and not put into the stock market because you know you can't risk everything.
Yeah.
You don't want to put all your eggs in one basket. It's a diversifier. And that's I'm going to stop sharing my screen here and let's go back to talking one-on-one. So all of this is well and good. It might seem like philosophy, big picture, what does this really have to do with you and me? And the things we want to underline are the importance of saving. Wherever you're going to save, high yield savings accounts, buy treasuries, do CDs, put it into a whole life policy, do something to save because your long-term future depends on it. And the earlier you can start saving, the better. Even if you start with 1% and grow from there, you're going to learn more. You're going to experience what you like and don't like. Don't just stay this way or the highway, right? Like where you have to do the same thing. You can't learn new things. You're not going to question conventional wisdom, all that kind of stuff.
And again, savings is not investing. Again, saying in this, the banks didn't incentivize us for a long time to save, but now all of a sudden the interest rates on savings accounts are higher.
Yeah, they're high. Why? Yeah. Well, I did some math. If you want to know what so I did an increase in interest rates on debt is much more impactful to your financial future than an increased interest on savings accounts. So if you want to talk about that, let me know.
We might do a video on that.
We should do, yeah. If you want that video, comment, let us know you want to see that math, and I'll do that math. It'll be fun. But for now, we want to give you hope that yes, interest rates are going up. That means really positive things for savings. And we want to give you encouragement to save, to do awesome things when it comes to your financial future. Even if it feels really difficult to do that, start with 1%, build that muscle, and keep learning, keep expanding what you believe is possible.
And do your research, right? For me, I think it's really important to not just question or listen to the people who are like us, right? You want to maybe trust, but verify. And this was at the end of this video. He had said in the video that banks don't do this. Banks don't do any of this kind of thing.
We already talked about this.
But we didn't bring that up.
Yeah, I shared. You can go check and see on the internet that they totally do. In fact, I looked up one that we bank with, and they own 18. Yeah. Or it was 18. I forget. Anyway, a lot of money of life insurance.
So again,
cash value life insurance.
All that to say is, don't do what the banks tell you to do. Do what the banks do, and learn that a lot of times when we are growing or moving, learning how the money system works and how debt plays into it, how Fed, all this kind of stuff.
All the things.
Yeah.
This video is getting kind of long. Let us know if you like this more impromptu, fighting back and forth type episode. And we'll start working on the next one and hopefully agree on what we talk about next. So
and hopefully,
buttons.
Literally, I really don't want to do counter Dave videos and all this stuff anymore. I just want to change people's lives.
Yeah. Right? So thanks for joining us. Hit that subscribe button and live long and profit. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.